Building next-generation artificial intelligence requires engineering breakthroughs, but it also requires oceans of capital. The primary bottleneck in the AI race has shifted from the manufacturing floor to the massive financing required to buy the hardware. On August 10, 2026, Nvidia announced a partnership with Wall Street to change the math of the industry. They are converting computer chips, hardware that usually depreciates in value, into an investable, yield-generating infrastructure asset. The coalition includes titans like BlackRock, Blackstone, and Apollo. Together, they plan to mobilize $500 billion in third-party capital to fund AI data centers. This alliance places the future of AI development in the hands of mega asset managers. Access to massive debt capital now dictates which laboratories can train frontier models, shifting the focus from the engineering lab to the balance sheet. While equity bulls celebrated the influx of liquidity, a vocal contingent of short sellers immediately raised alarms. Investor Michael Burry issued a public warning. He argued that this massive web of off-balance sheet financing creates circular spending loops, masking whether true end-user demand for AI actually exists. Fellow short seller Jim Chanos drew a direct line to the late 1990s telecom crash. Back then, equipment giants like Nortel extended tens of billions in credit to unproven startups to buy their gear. When the startups failed, historic debt write-downs followed. Now, financial markets are staring down a $500 billion question. Is this framework the bedrock of a new digital economy, or is it just a heavily leveraged vendor financing trap? To see why this is controversial, we have to look at the mechanics. Historically, AI labs and cloud providers had to drain their own equity to purchase hardware outright, a massive direct capital expenditure. The new Wall Street consortium bypasses that direct sale. Instead, financial partners establish independent special purpose vehicles, or SPVs. These vehicles buy the Nvidia hardware and then lease it to the end users at long-term, predictable rates. To fund these hardware purchases, the SPVs issue private credit and asset-backed securities. They sell this debt directly to conservative institutions, like pension funds and insurance companies seeking steady yield. To convince these lenders that AI servers are safe collateral, Nvidia offered a guarantee. CEO Jensen Huang clarified that Nvidia can backstop up to 25% of select project financing opportunities, taking the first hit if a lease defaults. This entire structure was made possible by specific SEC regulatory exemptions, which paved the way for these massive tech-backed debt instruments to exist. This structure generates $500 billion of liquidity from the private credit markets, while keeping 75% of the potential default liabilities off Nvidia's corporate balance sheet. Critics call this vendor financing, a practice where a manufacturer bankrolls its own customers to boost its own revenue metrics. During the 1990s telecom crash, when startups went bankrupt, the expensive fiber optic cables buried in the ground became useless, stranded assets. Lenders took catastrophic losses because the hardware couldn't be repurposed. Nvidia's defense centers on the CUDA software platform. Unlike static glass cables in the dirt, GPUs operate on a software ecosystem that is continuously updated to optimize hardware for new AI models. That software integration makes the processors highly fungible. If a startup defaults on its lease, lenders don't have a stranded asset. They can remotely reallocate that compute capacity to another user on the global network. The survival of this entire ecosystem rests on this premise. If CUDA makes GPUs fungible, the debt is secure. If obsolescence outpaces those leases, the SPVs face cascading collapse. Beyond the bubble risk, this financing engine acts as a strategic barrier to entry. Signing a multi-year lease through an Apollo or Blackstone vehicle contractually binds a laboratory to Nvidia hardware and CUDA software for the life of the agreement. This creates a hurdle for competitors like AMD or Intel. To win a customer, they can no longer just engineer a faster chip. They must now assemble an equivalent Wall Street banking syndicate to match Nvidia's access to debt capital. By weaponizing the liquidity of U.S. capital markets, Nvidia has successfully frozen out its competitors for multiple generations of development. This brilliant financial engineering is ultimately constrained by physical utility. These debt instruments are dependent on electrical grid capacity, which is currently a massive global bottleneck. If power delivery to a data center is delayed, the leased hardware cannot operate. If the servers aren't running, they generate no revenue to service the SPV's debt. Public pension funds and insurance companies now carry the weight of a potential tech failure, as these hardware liabilities are packaged into asset-backed securities and sold across the global retirement system. Nvidia has built a $500 billion machine to win the AI war, but in doing so, they have inextricably linked the stability of global credit markets to the utilization rates of their microchips.